Hey there, everybody. Welcome back to 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. Wonderful to see you all. Thank you so much, everyone, joining our live stream last Friday. Felt it was certainly for me, a very productive conversation. Really gave me some good opportunities to think through some of your questions, incorporate some of that into my own thinking. As I promised last week, I mentioned that in addition to the sorts of thoughts that I would be investing in thinking about our day-to-day price action and what we were looking at over the course of last week, that I was also going to be thinking about what that meant and what its implications were heading into January Opex. So I've spent a lot of time this past week thinking about what is really coming up for us here and what this particular week means heading into January Opex. In particular, how I could express some of these factors to make it clear how really I needed to be thinking about heading into this particular period, what that would mean for this kind of requel idea that we're thinking about, whether we should be expecting some sort of major upward volatility event, whether that's completely locked in, or whether perhaps institutions may be using that sentiment, that positive sentiment regarding GameStop's recent bullish action in order to rug pull, right? In order to send us back down the ladder and possibly fleece some people out of some of their more overextended bets, likely in the options market. So I'm thinking about that today. My post in particular, so a couple things about the post today. First of all, for those of you who are joining us who may be new to the channel, every day I publish analytics which focus on both technicals and the options market, options data in particular. I take a close look not only at our open interest, but at especially our gamma exposure data, what that means as far as market maker hedging is concerned. And I publish this data as well as my analytics on my X page in an analytical article. If you're viewing this on YouTube, you can find today's article pinned, linked down in the description of this video. If you're watching this on X, you can find it pinned at the top of the page. Those are available pre-market every trading day. Today's article is a bit more involved. I wanted to make sure that I contextualized a lot of our recent activity, going back really like where we are, not only over the past couple of weeks, not only over the past month or so, but really where we are with respect to this past year of trading, how we're looking, how these events back in May and June, really all the way back to March of last year, are continuing and have continued to shape our price action up to this point, what our price action and what this OPEX means in relation to those events, as well as some of the dynamics that have been recurring in GameStop going all the way back to this major upward volatility event, the so-called sneeze back in 2021. So there's a lot of that in this article here today. Some of that may be, completely a rehearsal for a lot of you, maybe who are more familiar with some of the dynamics going into this. A lot of this is to present my ideas within a sound context. Much that I present here, and I point this out in the article, is not necessarily my original research in the sense of things that, I discerned by combing through ETF transcripts or something like that, right? I make sure I point that out. But I bring this together here, and I have thought about, I decided to synthesize this in particular because it highlights why this week in particular is so important. And we're going to dig into some of that today. That is available up on X. We won't get to maybe all of the nitty gritty of that, but go ahead and take a look at that if you'd like to follow along with some of the more detailed points. On top of that, for some reason today, about a half hour before I published my article, it stopped saving for some reason. So about a quarter of what I usually publish in that article was left off of the end. I've tried to sprinkle it in some X posts that you can check out if you're viewing this live now toward market open. You can find some of those sprinkled, especially the GEX table. You'll see me flip back and forth to some of this here. I will try to edit this article as soon as I get my video published for today. So hopefully that's not going to be too much of an issue. Okay, so let's hop into this. Right, today's article is titled January Opex Turning Point. And this is the argument for today, right? This week is a very important week. And I will state this specifically, right, why I think this. I'll say what I think, I'll state my proposition here, and then go into detail as to why I've come to that conclusion. Okay, very directly, this week is a turning point, specifically because it will determine whether our bullish momentum will continue in the near future, whether we're going to see a continuation of our current trading paradigm, a continuation, right, sustained support in these lower to mid $30 price range levels, whether we're going to have the market maker hedging structure in place that lends itself to supported trading at those levels, or whether we will lose that support and then go into something of a perhaps a multi-month retrace or correction, most likely, right, perhaps seeing some weakness at the $30 level, maybe even seeing something that retests price levels down in the mid to maybe slightly upper mid 20s range heading into February and early March, before we have a chance to move back to the upside and potentially drum up some more bullish momentum once again heading into the annual earnings release, which should come out sometime around March 26th, is what I'm projecting there. So the first thing to understand, okay, why would this be the case? Why would I say, oh, January Opex, this is this really critical turning point? And I want to bring our attention to a meme, right, that Roaring Kitty here posted back here in 2021, in March of 2021, just a few days, I believe, or right around the annual earnings report for GameStop in that year. And what we have, right, we don't have a caption, but we have a GIF here of Matthew McConaughey overturning a squashed, flat Lone Star can of Lone Star beer, right? He's sitting, being interviewed by these detectives. This is from season 1 of True Detective. And what he is talking about here, what he's referencing is a concept, or he's referencing this concept of the eternal recurrence from the thought of Friedrich Nietzsche. And he's famously, in this scene, right, his very quotable line is, "Time is a flat circle." Of course, here's the extended quote here: "Everything we've ever done or will do, we're going to do over and over and over again. And those children are going to be in that room again and again and again," right? He's talking, of course, about how he was haunted by his experience in thinking about these particular children, right? The loss of his own daughter, these children that he both rescued and failed to rescue, who are captured by the drug dealers, these like King in Yellow, pagan, cultist, Santeria drug dealers who drug up and torture these children. So DeWall and Reggie Ledoux, who have this compound down in Louisiana Bayou, right? So he's very haunted by these memories. And he's talking about this concept with these detectives and thinking about how, man, no matter what I do, what we're going to do, this idea of the eternal recurrence, we just move in these cycles. So everything we do in this life, we are born again into the same life and go through this, right? This kind of hell of being reborn into the same life over and over again, right? Without getting too metaphysical on this, the idea here, right? What it seems to me that Roaring Kitty is referencing is an idea that I talked about this a bit on Friday, right? But what user, right? A number of them have talked about this, right? So more recently, Richard Newton's been talking about this. Otherwise Category and his big DD has been talking about this, but really someone who's put quite a lot into work on this topic, whom I've had the chance to speak to recently in the limited capacity and who we talked about a bit, whose work, I should say, we talked about a bit on Friday during our live stream, is u/Gherkinit, who has talked about the ins and outs of this sort of liquidity and volatility cycle. So I have linked here, right, both how we talked about it on Friday and some of the work that Gherkinit has done here. And really, so what's involved in this cyclical element? Well, one of the ways in which the market as a whole, in which institutions and market makers in particular have been able to make substantial, if indeed outsized profits off of GameStop, has been through this alternating process of drumming up volatility and with it the price in GameStop, and then selling this volatility while simultaneously shorting the stock. Well, remember, of course, right, many people are familiar with the idea of Citadel, of Melvin Capital, of Citron, and others shorting GameStop excessively and attempting to seller box the company, right, drive it into bankruptcy through their aggressive short selling tactics. That famously in 2020, right, the entrance of Ryan Cohen into the stock, the letter to the GameStop board by Michael Burry, the publicization of these dynamics of the potential for outsized returns on GameStop by Roaring Kitty, alias DFV, Keith Gill, to the broader Wall Street bets and online investing, not exactly community, but sort of spontaneous generation of social relationships, right, that this foiled this attempt to seller box the company and forced many of these major institutions to change their strategies. In particular, they pivoted from simply attempting to short the company into trying to offset some of their potential losses by packaging and selling volatility, right? This is in particular how Gherkinit verbally frames this particular phenomenon, right? And this is done primarily through selling calls on GameStop, right? Because of the particular IV dynamics and how they correspond with increases in GameStop's price. The best way to go ahead and sell volatility, to sell implied volatility or IV, is to sell it in the form of covered calls. So, right, somebody, I think it was Maxi King in particular at our stream on Friday, brought this up. Yeah, right. When you're making an options bet, you're not just betting on a change in the price. You're also going, right, you're not just going long or short the price of the underlying equity, but you are going long and short the volatility of the underlying equity. So a short call in particular is both short the price and short volatility. So on GameStop, because there is a direct rather than inverse correlation between the price and the volatility in the stock, that short calls being both short the price and short volatility it is an instrument that is directly correlated to take advantage of that particular relationship, right? So as price and volatility goes up, it incentivizes these short volatility trades. But in order to ensure that short volatility trades work out, one must supply short volume in order to suppress the price and suppress volatility. Okay, where does that short volume come from? How can you be sure that there is sufficient liquidity, there is a sufficient availability of borrowable shares in order to guarantee that that type of price action will take place and that your short liquidity trade, I should say your short volatility trade, will be profitable? This is exploited by institutions by tapping into exchange traded funds, right? So institutions, authorized participants can engage and request creation and redemption orders where they borrow shares of GameStop from exchange traded funds, from ETFs, and then fail to deliver them in order to meet share obligations, short share obligations on GameStop, right? So you go ahead, you borrow these shares from the exchange traded fund, you immediately short them, you sell these, you depackage them, you decouple them from the ETF, you sell them short, suppresses the price of GameStop, volatility goes down, you fail to deliver, right? You make sure that you don't have to pay a fee on the shares of GameStop itself, but now you go ahead and you fail to deliver those shares to the ETF. You now have roughly a 35-day counter, a 35-day timer before you actually have to go and get those shares back, purchase those shares on the lit market, and return them to the ETF such that you are not put under more restricted short selling regulations. For example, something like Reg Show, right? The Reg Show threshold security list, like XRT is on now, a GameStop holding ETF. Which is frequently tapped for this purpose, right? Richard Newton's talked about this a lot, and in detail and in a way that's easy to understand. So I would highly recommend you check out his videos on that topic. He frequently touches on that in his regular day-to-day videos. So what occurred, right, sort of roughly back in 2020 was individuals like Ryan Cohen and Michael Burry, to a lesser extent, I mean, importantly, for a public context, right? Keith Gill, Roaring Kitty, although at the time in 2020 he was not himself capable of moving markets with his own portfolio, with his own resources, right? But especially Michael Burry and Ryan Cohen were able to reveal that these types of cycles. So it's very likely, with this reference to Matthew McConaughey and True Detective, this reference to Nietzsche's eternal recurrence, the idea of time being a flat circle, that Roaring Kitty himself was quite aware in March of 2021, and perhaps even prior to that, of the cyclical nature of failing to deliver, shorting volatility. And then, of course, right, the other component to shorting volatility is, once you've shorted volatility enough, once you get to the end of your ETF FTD cycle, you then exit out, right? You exit out, you slowly ease your way out of your short volatility position, and then you buy back your shares. The price goes up with it. Liquidity comes in as buyers seek to take advantage of this upward move. You then use the correspondent volatility spike to short the stock again, right? To short volatility again. You go to a different ETF, you go to the same ETF, you borrow more shares, you short the stock, and so it repeats, and so it repeats, and so it repeats. And in particular, in 2021, for most of 2021, the GameStop price, right? And if we take a look at this chart here, right? The GameStop price remained very buoyant throughout here, right? We didn't really touch any new lows. Basically, heading into November of 2021, the stock price wasn't going anywhere, right? Everybody was saying, this stock, it's terrible. It's a dying brick and mortar, blah, 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 blah. And yet we had these major cycles in the price. Okay, we had some lower highs, but found support, right? And in fact, heading into the end of the year, we were looking at a pretty bullish pennant formation in terms of lower highs, but lower lows, until right around the end of November. And Gurkinit in particular has written about this. He particularly states that there was a very heavy amount of short volume, an unusually high amount of short volume that headed into the end of the year. And what seems to be the case heading into 2022 and then 2023 was the setting in of a broader bear market, right? So we can see that these cycles continued, but due to external pressure, right? So rebalancing and sort of thinning of GME holdings in broader market portfolios, perhaps retail sector portfolios, GME was able to have this kind of bearish momentum in it, while there was bearish momentum in the broader market. So you can also see this, right, reflected. You can see that our IV, our implied volatility patterns, largely match up with these spikes in the price, right? So we can see these turn dates, and we can see each of these cycles play out, right? At least that's the theory here. Right, within these bear market conditions, between which set in right about the end, right? So right at the end of 2021 was basically a peak in the market. And then as soon as we get to 2022, we enter into big bear market conditions, higher volatility conditions in SPY. 2023, we get something of a recovery, but the bear market officially does not end until after Opex in January 2024. So actually just last year, right? We were not truly out of bear market, or at least range-bound kind of market, sideways trading conditions until January Opex of last year. So only the past year have we seen bullish contextual market conditions restored to our broader trading environment. So in 2022 and 2023, we had these cycles, but also a general bearish context for GME to trade in. Now, some important things occurred over the last year, of course. We had Ryan Cohen named CEO of GameStop in 2023. He put his vision for reforming the company, for sort of shoring up the balance sheet into play. And by the announcement of the 2023 annual earnings report in March of this prior year, GameStop had actually turned in a profitable year for the first time in several years. So I have all of this outlined, right, step by step in the article. So we'll just move through this at a brisk pace. So this was important because, right, fundamentally, GME is not the same company while it is profitable. In 2021, 2022, 2023, even 2020, while all these other market factors are going on, while GME is going through these different cycles, fundamentally, this company is not changing that much, right? It's okay. They were able to acquire some decent cash reserves, but still this was a company that was showing a burn rate. And when you show a burn rate, you look like something like AMC does right now, right? AMC burns through its cash. It's not a profitable company. When AMC goes ahead and does capital raises, it needs that capital to stay alive. These are survival capital raises. When it came to GameStop, because of Ryan Cohen's actions between over the course of 2023 into early 2024, GameStop has actually turned itself into a profitable company. Barely, just so. But when you have $1 billion in cash and you're a profitable company, you don't have a burn rate, that $1 billion looks different, right? That's not just a capital reserve to stay alive. That's something you can potentially use in order to develop the company to potentially influence earnings growth, or I should say revenue growth. And furthermore, what changed right around this earnings report in March was the fact that the 2022-2023 bear market had come to a close. Now, that didn't stop GameStop from selling off immediately afterwards. And this is likely because in the broader context here of the market, we actually went into this month-long correction. So from March Opex on SPY into April Opex, we actually had this pretty big correction, right? SPY traded down, the market traded down to the 100-day moving average. So a decently long correction that the ship didn't right until thereafter. So we saw this another repetition, another iteration of this volatility goes up leading into earnings. Short volume comes in, short volatility sales come in. Institutions, market makers, traders, they set up these short volatility positions. They sell a lot of calls and then short the stock in order to decrease volatility to then cause premiums to appreciate in their favor, right? Premiums to depreciate as they are short those contracts in preparation for going ahead and potentially buying them back or having them expire worthless, as generally with GameStop, as we've seen, about 90% of all call options expire worthless, that is, out of the money. So despite these changes, this still occurred, right? Despite these changes in the fundamentals of the company and despite the contextual changes in the broader market, locally to March and April, we had this brief re-entry into more bearish market conditions in this correction. And so we saw a new low. We saw a 3-year low on GameStop as it traded down to just below $10. However, coming out of that, there was a bit of a surprising recovery, right? The stock actually within the span of a couple of weeks traded back up to the levels that it had seen just prior to earnings very quickly, and then began over the course of another couple of weeks into the first week or two of May to set year-to-date highs that actually exceeded some of the higher points toward the end of the trading year in 2023. Of course, this doesn't necessarily mean that if you are short volatility, if you are short the stock, that, oh my gosh, game over, right? What you can do, in fact, Richard Newton's talked about this. He featured this video. Who is the name of this this particular trader? Right, there's this particular former quant trader who used to work for a prop trading firm. This gentleman who travels across. He's sort of driving around. Yeah, he's sort of driving around the country right now. And right, he left trading. And let's see. What's his name? I forget his name, but in any case, he talked about a particular strategy called martingaling volatility. And that basically a very common strategy that he's seen traders within proprietary trading firms engage in is that if they find themselves squeezed out of their short volatility positions, that a very common way to get out of this situation is simply to double down on your bet. And you can do this as long as you have sufficient margin requirements or sufficient margin allowances, I should say. Every time this doesn't work for you, you can simply double down on your bet again. Double down, double down, double down, double down. Eventually, the idea is you will win, right? This can't go on forever. Certainly, the probability each time that you double down that you will, the price and volatility will not reverse, gets statistically less significant. Right, you move out standard deviations of probability as you do this, And that eventually, right, you'll not only make back all your money, but you'll make back all your money plus some whenever this does work out in your favor. So what looked to be the case in May heading into June Opex, which is one of the yearly leap states, right? June, December, and well, June and January especially are leap states on equities on GameStop. So, right, this seemed that this kind of unexpectedly strong recovery in early May, end of April, was simply something that volatility sellers could double down on, could martingale their way out of. And this is exactly, right, the theory here is this is exactly what Roaring Kitty saw as an opportunity to lay a trap. And so what he did, what it seems to be the case, both with his posts and with his very large options bets in May and June of 2024, that he was able to very seriously complicate the ability, right, complicate the strategies and catch some of these institutions who are used to having free reign over their ability to create synthetic liquidity through ETFs and generate the credit and cash necessary to offset margin requirements, in order to have the allowances to go ahead and martingale their short volatility bets. That seems to be the case of what he was doing there, and what he successfully pulled off. Right, he had some pretty amazing results as far as first revealing these memes, which then greatly spiked right as dealers. As attention got put on the stock, right, many institutions saw this as an opportunity to pump the price and trap maybe some of these institutions that needed synthetic liquidity, right? So what they do is, when you're in this situation where sort of you run out of your short bets go underwater, your short volatilities trades go underwater, you can raise IV, right? You have institutions, market makers have control over IV. They can raise the implied volatility and the effect that it has on the premium values of options contracts in order to collect more and higher premiums in order to offset these potential portfolio margin issues. Roaring Kitty looks like he was able to exploit that by then preventing the price, once the price had gotten up, by preventing the price from moving back to its April levels, sort of the bottom of this March-April cauldron levels, by purchasing a very large number of call options, which placed market makers in a position that they could not de-hedge themselves. They could not go ahead and let go of many of the shares they had acquired in order to hedge their options positions, those very positions that they themselves had allowed traders such as Roaring Kitty to open in order to create more liquidity for themselves, in order to get more cash to balance and meet their margin requirements. That very dynamic had allowed Roaring Kitty to trap the price, or I should say, allowed Roaring Kitty to allow market makers to force themselves through their own hedging practices to trap the price at a higher level, which they did above $20. In fact, even though Ryan Cohen had issued a 45 million share escape valve, this still was not enough for these short institutions, both short volatility and short the price of the stock, to fully meet all of their ETF FTD obligations. And so, right, the price of the stock ran back up. And it seemed as though, this is certainly otherwise categories thesis here, it seemed as though that given the price on June 6th, looming as it was prior to Roaring Kitty's June 7th live stream, that based on the price of the stock at that point, Roaring Kitty could have live on his stream exercised his options contracts. He could have exercised all 120,000, meaning market makers would have had to deliver 12 million shares to him instantly. And that he could have done that because of the value of the options contracts themselves. There was enough value in his options contracts, in his contracts themselves, that he did not need to contribute additional cash to his position in order to exercise every single call that he had. And that he possibly planned to do that live on his stream back on June 7th. Were it not for another at the market offering, this time of 75 million shares, it's very possible that he could have done that. Now, many were potentially disheartened for what that meant for the fate of this potential volatility event going forward. And indeed, it did largely transition us back into another period of cycles. So back into this time as a flat circle, more ETF FTD cycles, more short volatility trades. And this is what we saw take place later in the year. Certainly, I wrote about this as we went into our Nikkei crash bottom, as we went into Q2 earnings in September. It certainly looked like, okay, we're just going to go through this process ad infinitum. If Roaring Kitty is going to come in like he did as well in September, if he's going to come in and drop these tweets, and institutions are going to exploit this in order to jack up implied volatility, then institutions believe that they would have Ryan Cohen there sitting in the wings, willing to make a number of company shares available in order to give them an exit liquidity valve, allow them to cover their FTD requirements, their ETF synthetic liquidity failed to deliver obligations, that they would be able to do that and then continue to perpetuate the cycle. So this looked like, okay, Roaring Kitty's now in the picture, but Ryan Cohen's in the picture now, and he's choosing to use these volatility spikes that institutions are causing in relation to Roaring Kitty's now participation again in GameStop and in the broader market, right? Not necessarily in GameStop. We've seen him operate in different stocks and tweet with respect to different stocks, and yet it causes effects in GameStop. And this looked like the case, right? This seemed to be the case heading in and out of earnings in September. So another volatility cycle, another post from Roaring Kitty on September 6th, and then another at the market offering on September 10th that allowed these short institutions and volatility sellers to short the stock back down. But this, as I point out, this, it seems, as we've all seen now take place over the course of November and December, was yet another trap. So once again, we engaged in this price action in November, a sort of an uptick, a drastic increase in volatility that seemed to be connected to some Roaring Kitty related events, right? The filing of his 13G announcing that he had exited his Chewy position on October 29th, National Cat Day, that somehow he had foreshadowed 3 years in advance via user avocado in my anus on Reddit. And that, institutions perhaps also recognized that many retail players, retail investors would likely respond very favorably to this, and therefore they thought perhaps to cause some sort of event, right? Who knows what was really driving this? What we did see in the middle of November was that many institutions, major institutions, had filed 13Fs, announcing that they had increased their positions in GameStop significantly, and that it is possible that the processing or the sort of the delivery of shares or the sort of meeting of settlement obligations of many of these positions may have caused this upward movement into Thanksgiving of this year. Of course, who can forget that we began to be shorted heavily as we approached earnings in 2020. In December of this past year, of December 2024. Right, so from 11/29 all the way into the 5th of December, the stock was shorted pretty heavily. I had written in particular about noticing some tactical rerouting of order flow, bullish order flow that seemed to encourage and permit this type of shorting. Of course, this was accompanied by quite a lot of volatility sales. And what did we have? Of course, in the middle of this, we got another Roaring Kitty post. The stock traded up quite dynamically. However, it seemed as though these institutions were not to be daunted. IV was still high as a result of the anticipation of earnings. It seems many institutions martingaled their positions again off of Roaring Kitty's post in the expectation that Ryan Cohen would go ahead and did as he did in the past 2 earnings reports, that is, make a significant number of shares available for purchase via an at-the-market offering. However, Ryan Cohen then pulled his own trap, which was to announce that not only did GameStop have surprisingly bullish results of its Q3 earnings, but he had no intention, and the company as a whole had no intention of offering another at-the-market offering for the remainder of the fiscal year, which meant that everybody who martingaled into positions, short volatility positions here, suddenly had no escape valve, right? They had no escape valve. And so the price action that we've seen continue into the end of the year here and into January, right? Now there are 2 of them, right? Is such that we've seen the stock push up into a new gamma exposure bracket, right? Push above $30, hold that position, trap anybody who entered into short positions after 1129 underwater, right? All of our price action from, let's see, from after December Opex all the way up to now into January Opex has been all above the short underwater line, the level at which shorts entered heading out of Thanksgiving, I should say. So what it looks like is this price action that we've recently seen may have been driven by shorts in particular, maybe with margin calls, maybe looking to purchase shares to relieve themselves of their FTD obligations. Something like that looks like it's the case that may be together, maybe with some retail excitement, something like that, the anticipation of a equal type price movement that in particular may have been what's driven our price into the end of the year here, or I should say into the end of the year and the beginning of the year into January Opex. So what does this mean, right? This means in particular that over the past few weeks, that while this has occurred, right, basically since the filing of earnings on December 10th and the announcement that GameStop would have no at-the-market offering, that GameStop has been in the case under the conditions of a liquidity crunch, meaning there just aren't shares available to borrow, to use in order to cover some of these failure to deliver obligations based on ETF synthetic liquidity fails. So there's some evidence for this. Certainly the dwindling pool of shares available to borrow heading into January was one indication, as well as the fact that XRT, one of, if not the most popular ETFs for creating GME synthetic liquidity, has been on RegShow since, that is the RegShow threshold security list, meaning that the timeline at which fails to deliver must be settled is about 1/3, a little more than 1/3 of its usual length, and that has been the case since the 23rd of December. So GME right now, into January Opex, is still within a bit of a liquidity crunch. Its liquidity is somewhat jeopardized. We saw last week that despite our kind of side-to-side, our kind of sideways price action, nonetheless, we had these unusual spikes in implied volatility. In fact, that was the case on Friday, right? For basically no reason, on unassuming, basically some of the flattest price action we've seen in weeks. GameStop nonetheless shot up overnight between Wednesday and Friday, right over the course of this Thursday market holiday, that the implied volatility shot up from the stock from about 115% to over 135%, really on minimal price action. So we see some of the signs of restricted liquidity and its effects on GameStop's implied volatility. Now, that's been the story so far. Why does this make January Opex particularly important? Now, January Opex is a leap state. It's both an equities leap state and it is an ETF leap state. Accordingly, GameStop has been able to accrue options open interest for January 17th for the better part of the past 2 years. What this means is that the open interest positions, especially calls, heading into this OPEX are the largest that we've seen in some time. December OPEX was pretty large, but one of the things that kept our price buoyant coming out of December OPEX was the fact that January OPEX was just as large, if not larger. Indeed, larger than what we saw going back to December OPEX. We have some extremely heavy concentrations of call open interest, notably at $30. In fact, the reason that $30 has proven to be so strong of a downside support over the past couple weeks, that it has framed our trading, is because there are so many contracts concentrated here, over 28,000. And that makes this position a very strong concentration of dealer gamma exposure. Dealers are mostly short at this position, right? Retail institutions are mostly long versus this position. We're long this position heading into this month, have been buying $30 calls, for months and months and months. Dealers have been shorting these calls, providing these calls in their role as designated market makers, particularly someone like an institution like Wolverine Trading has had to fulfill this role. And now these $30 calls are in the money. So what this means is, on the one hand, these calls heading into OPEX are in a positive charm regime. So this means that the delta values of the $30 calls appreciate as we run out of time, right? As time goes down, as theta decays, theta being the options variable responsible for measuring time, as theta decays, delta increases because these contracts are in the money. So over time, this means that as theta goes down, rather than say an out of the money contract, where as theta decay occurs, right? As theta goes down, delta goes down. With an in the money contract, as theta goes down, delta goes up. So dealers have to purchase additional delta hedges in order to make sure that they can meet their share delivery obligations with respect to those contracts. At the same time, there is a lot of gamma exposure concentrated at this $30 strike because we are still very close to this mark. Now, gamma is the variable that measures the rate of change of delta. Delta, of course, measuring the change in the price of the options contract with respect to a single dollar change in the underlying share price to which that options contract references. So with gamma hedging, right, gamma accounts for the potential for quick changes, the acceleration of delta changes with respect to a particular contract's delta. So the gamma values on a contract are always largest as that contract is moving in and out of the money. So even as, right, so what they're preparing for there, right, what gamma helps them sort of hedge against is a very quick snapback in the opposite direction as that level is approached, given its significance in a number of different areas as a probable reversal point. So as those delta values decrease, the gamma values actually increase in the expectation that there may be a reversal back to the other side. That should there be a reversal, the delta values will snap back in the other direction. So even as those market makers sell delta hedges, they relieve themselves of delta hedges, they then have to counterbalance that by buying gamma hedges. So what you see is a support point. You don't have that level necessarily of decay in approaching that point that you might otherwise expect. So gamma hedging, as that level is approached, specifically call gamma hedging, keeps the price buoyant and supported as $30 is approached. Okay, why does that matter for January OPEX? Well, that matters for this week because January OPEX has been exerting a very substantial effect, a gamma hedging effect on the part of market makers for a while now. It's been contributing to the total gamma concentrated at that strike, not just for this week, but right into weeks prior as this strike has been open, as these contracts have been able to be open, market makers must account for hedging them as well, right? It's not just whatever options expiry is most proximate to whatever trading day we happen to be on. Nearer trading days will exert a stronger gamma hedging effect, but especially for an options position this large, for an open interest value this large. For many weeks, right, going sort of months into the past, this position has been exerting an influence. Now that it's in the money, it's offering support. But come Friday, these contracts will be gone, right? They'll be wiped off the board. And market makers will no longer have to hold shares in order to hedge the potential for needing to satisfy the delivery obligations with respect to this strike and with respect to this expiry. So unless we get something this week, right, unless we get some strong upward volatility event, unless we get something from Roaring Kitty, unless we get something from Ryan Cohen, unless we have something like a swap rollover or something like that, then this price level is going to be a lot less supportive from the perspective of dealer gamma hedging heading into our next few weeks. In fact, we have less than half. We have only about, it's more than a third. We have less than half, maybe about 40% of the total OI, the total number of calls for our next 5 weeks. If we take all of our next 5 weeks together, going all the way over to February Opex, right now, we have less than half the total amount of open interest that we have just for this week at $30, not accounting for other strikes. So, right, unless we have something coming up that's going to encourage institutions, it's going to encourage retail traders to go ahead and buy more calls to fill out the options chain for next week, the week after, for February Opex, unless we can move, I say, right? This is not trading advice. This is not saying, hey, you go out and do this. I'm not saying that. But unless, let's say, traders and institutions as a whole decide by virtue of these other influences that making these types of bets, by building out these types of positions, by placing dealer gamma, by forcing dealers to take short call bets via their own trades to be counterparties to their own long call bets because they view that as potentially profitable to their own positions, then we're going to see some of the bullish momentum that we've enjoyed for the past couple months be at risk. Now, it's not necessarily going to mean that, oh my gosh, we just retrace $10 in a month and the whole thing falls apart or something like that. Maybe that is something that's that the market is trying to set up here. We've seen something like SPYs flirting with some lower levels, something like that. Although Spot Gamma, Bravos Research are not super concerned right now, while we remain supported, I believe also again at the 100-day moving average. If I just take a quick look over at SPY here, I think we're pretty close to the 100-day moving average, which in this bull trend has served as a support. We've moved through it. So there's maybe some concern there. I think Spot Gamma is pretty confident on this so long as we stay above the volatility trigger, which I think is a bit lower than where we are now. We're at 578. I think volatility trigger may be around 575. I'll have to check on that. We are in these bullish, these more bearish conditions in the market. It's actually pretty impressive that GameStop has been able to retain these price levels despite these factors that we've been seeing in the broader market. But if we are going to expect bullish conditions to continue for GameStop, that we'll see some continued movement, say up into the 35-40 bracket, we're going to need, or it's going to be difficult to do that without some serious expansion of our call open interest and of dealer short call gamma heading into and heading out of, I should say, January Opex. So we'll have to see what that's going to bring for us. We won't know, right, until we see what's going on this week. Of course, I will, I'll be tracking this as I usually do. I'll be publishing my analytics. I'll be publishing my write-ups, taking a look at our options data to try and get a sense of where it looks like we're heading. If we don't get something like that, then I think we could look something like we looked like kind of heading into into quarter one of 2013, actually, right? So if we take a look at this chart here, right, we can see that we set up for a slow as situation, right? This is one possibility. We talked about this a bit on Friday. This was the event that Roaring Kitty actually studied that helped him recognize the potential for what actually did end up unfolding in 2020 and 2021. This had a major period of correction, right, for about 2 months, almost 3, really 3. It wasn't until March, right? There was a really range-bound kind of flat period for January, February, and most of March, heading into the annual earnings report in 2013. So the 2012 annual earnings report, which was very good. It was only after that that there was a very significant short and volatility squeeze on the stock that took the whole year essentially to play out, right? It went into November of that year. So if we don't get some sort of a catalyst like that, then what we're probably looking at into March is something like this range-bound dance that we saw take place in the first quarter of 2013. And that we would not necessarily emerge from that kind of range-bound situation, maybe playing between 30 and 25, something like that, until we got some catalyst like earnings, which it does suggest. There have been some posts from Ryan Cohen that suggest that we have reason to be bullish on the annual earnings report come March 26th. Something like that. So that's what I'm keeping an eye on. I'm trying to stay realistic. I'm trying, right, for my own trading or for my own investment, to think about, okay, how can I prepare for this movement? Is, not just like I want to get excited, right? I want to be all rocket ships all the time. I want to say, yes, oh my gosh, Roaring Kitty, he's definitely coming this week. Lo, the Messiah comes. But I also want to say, like, okay, what if we don't get that? What would that look like? And although I'm not downtrodden. I'm like, oh my gosh, the stock's going to fall apart, right? And none of the fundamentals, right? All of the fundamental characteristics of the investment are still in place. Everything about Ryan Cohen that I've seen, everything that I admire about Ryan Cohen and what he's been able to do with the business, all of that stands. And what I've seen him do, certainly, not only as an investor, but how I've seen him react and be able to defend the company from some of this predatory financial behavior. Predatory behavior, I should say, from financial institutions is, that's exactly what you want to see in a CEO. That is a rare skill set. And the very fact that he's been able to execute on many of these events to the advantage of the company, is not only good for the investment, but man, if he didn't do this, I'm not sure I would even know anything about this. So that's certainly a CEO that at least at this stage I'm certainly happy to put my trust in and to invest in. That's my perspective. Not necessarily telling you, of course, to you need to do your own research and come to your own decisions. Not exhorting you to invest in GameStop, but that's my outlook at this point. So, but yeah, a bit of a longer video today. I'm going to see if I can edit a bit of what got cut off from my report. For my analytics today, for whatever reason, I couldn't get this last quarter of the article saved. So we'll do some work on that. I'll see if I can get that up. But yeah, thanks very much. I hope you found this video informative. Really, if you know some investors and you'd like to help them stay informed, please go ahead and send this to them. So I really want people to be able to make the best decisions that they can based on as much data and information as they can, especially heading into a pinnacle and a critical week like this, and a really pinnacle and critical quarter as I've discussed here. So thank you very much. We'll look forward to another discussion tomorrow. Thank you so much again for supporting. We'll see you then. Take care.